I'm asked fairly frequently, how do you deal with retirement accounts when you're inheriting them? And there's really two main distinctions to be aware of. If you're inheriting from your deceased spouse, then there's no tax that's due. You can roll that inherited assets into your own existing IRA rollover or into your existing employer's plan and 401k plan as an example. And nothing's really changed. You will have to take some distributions once you're well up into your 70s. But other than that, everything's kind of the same as if it was your own retirement assets. But if you're not a spouse, if you've inherited from a parent, if you've inherited from an uncle or an aunt, then it's a very different circumstance. Underneath current rules, you have to take required distributions, and the entire inherited retirement account is paid out over a 10-year span, maximum. And so if it were just a very small amount that you were inheriting, you may just say, okay, fine, let's go ahead and just take this, and it's all income because in general, it's retirement accounts. There's not been income tax paid on them. So income tax is paid when it's distributed out. Roth IRAs are an exception. That's probably useful for another conversation. But over the typical inherited retirement accounts, you take a required minimum distribution every year, and it may start out as roughly 1/10, but then it goes to a 9th, 8th, 7th, 6th. And if it makes it all the way to the 10 years, if you've still been kind of taking it through time, then in the 10th year, the entire account is distributed out to you, what's left in it. And again, this is extra income that you're receiving during that 10-year period because it's generally taxable income as you're taking the money out. Unless you're a spouse, you have no choice. It has to be distributed out over a 10-year period.